Hey, Jeff, this is either going to be the most amazing episode of Investing Unscripted we've ever done or an utter disaster.
I'm going to put my vote firmly in the middle.
Yeah. Well, here's the thing. If it's the worst episode ever, that's amazing in its own special way.
That's true. We're going to try something completely different here, and I think it'll be fun. We'll find out.
Yeah, I got to think about that one. That's the tentative title. I'm Jason. He's Jeff. Welcome to Investing Unscripted, everybody, where we ask and answer the hard questions about investing. And Jeff, you want to lay out exactly what we're doing today?
All right. So this was just a random idea we came up with. I put a list of both of our stock portfolios into ChatGPT. I told it, here's a bunch of stock tickers for someone named JS. And I said, here's a bunch of stock tickers for someone named JH, because I don't like giving ChatGPT my real name. And I dumped them all in. And I said, later today, I'm going to ask you to randomly give me one ticker from each list one at a time. And Jason and I are going to, I will randomize the stocks for each of us. And then we have to give the bear case for the stock that comes up with no preparation. We promise we will not like pause the podcast and out while we go do research. If we edit anything, it'll just be like a long pause while we're trying to like open a spreadsheet or something. But it's going to be completely off the cuff, unscripted. You have to give the bear case. And then at the end, we're going to ask each other if we would buy that stock today. So there's like, it's like a 2-question. Oh, I'm sorry. One more thing. And we're going to give the 1-sentence thesis of what the company does.
We'll start off with that. Here's the company. Here's what it does.
Just in case you don't know what it is, right?
Here's the bear case. And here's the thing, like there's two things that I think we're trying to accomplish. Number one, we want to get through a good number of stocks. We want people that are listening to hear a little bit of information about the companies, but enough that if they're interested, they need to go do their own research on top of that. We want people to do that anyway, right? It's right there in our whole tagline. But I think the other part of it too is we're testing how much we actually know and conviction we have with our holdings, right? And putting ourselves in a position where we don't get to cherry pick anything. So that's exciting.
Yeah. It'll be fun. And I think the other part of it that's going to be interesting for me is I spend so much time thinking about what could go right with companies. I don't know that I spend as much time as I should making myself think through what could go wrong. I'd like to think when put on the spot, I will be able to come up with a bear case for every stock I own. We'll find out if that's true or not. So it's a little bit of a test for me to see how well I know my stock portfolio. What I hope happens, and this truly will be random, it'll be up to ChatGPT to tell us what we get. I hope we talk about stocks we don't normally talk about, because I feel like, you and I don't have enormous stock portfolios and we end up talking about our favorites a lot. So for the sake of the listener, I think it'll be fun if we get some ones we don't often discuss here. Before we do the show, I just want to put our housekeeping up front today, because it's been a while since we had a new review or a new rating on the podcast apps. And as we've said before, that's the best way people can find out about the show other than you sharing it directly. And we know we have many, many, many listeners who listen every single week. And there are more listeners than there are reviews. So if you're listening, if you enjoy the show, or if you're a first-time listener, you can wait till the end and judge. But we really appreciate everyone giving us a 5-star rating on the podcast apps, giving us a review on Apple Podcasts, and anywhere else that you find what we're doing. We really appreciate that.
Alternatively, if this is your first time listening, you can go ahead and give us a 5-star rating and then never listen to us again. I mean, that is also okay to do.
That's fine. Yeah.
But we would prefer if you continued to listen to us and you really enjoyed it.
Both.
Those reviews, they really do help people. So stop being lazy. Step up. You can do it. I believe in you.
There's our tagline. So you're going to go first, Jason.
Okay.
So I'm going to ask ChatGPT, give me one from JH's list. And you get LGIH. That's the ticker. I can guarantee we've never talked about this stock on the podcast.
I don't think that's true. I think we have, but never on its own. LGIH is LGI Homes, which is one of my basket of home builder stocks. So the 1-sentence thesis for LGI Homes is leveraging its substantial land portfolio to get caught up with the demand for starter housing and get through the downturn and leverage lower interest rates and the massive pent-up demand to outperform the S&P 500.
I like that. Isn't that the same one sentence thesis for every home builder?
No, no, the difference with it is they've accumulated a lot of land
Got it.
coming out of the pandemic because they blew through their inventory, and then they didn't have any developed inventory, and it took them a few years to kind of get. So they ended up with a bunch of debt and not a bunch of developed properties, and their revenues fell. They've got a pretty high debt leverage ratio. So that's actually the bear case for LGI homes is we've seen weakness in new home sales, and they have a lot of exposure in Texas, and they're Texas based, and in some of the other Sunbelt markets that are, I don't want to say saturated because there's still a lot of demand, but there may be more available inventory than there is demand to soak it up right now. And that either a combination of interest rates aren't coming down enough to unlock pent-up demand, and this weakness that we're seeing in the jobs market. We're seeing more people are staying on unemployment for longer. It's taking longer to find a job. We look at the Gen Z, the unemployment rate for younger for younger adults, and some of the older of that Gen Z are moving into prime home buying age. Unemployment's like 10% for that generation. It is substantial, right? So those are things that could create this perceived opportunity for home builders to meet this pent-up demand, be a false opportunity that doesn't turn into per share earnings growth for the company because of the weakness of its balance sheet in terms of leverage ratios compared to a lot of its larger peers.
Yeah, the other thing I wonder with home builders is just because we start building more starter homes doesn't necessarily mean it's going to unlock this flood of affordability for younger people who are looking to buy their first home. You know what I mean? Like, it's not just a supply and demand issue. It's an interest rate issue. It's the unemployment thing that you just talked about. So
yeah,
it's the reason, I've thought about adding more home builders to my portfolio, like building out a little basket, because I only own one.
Mm-hmm.
And I'm not even positive I own the best one. I just
You
own
don't,
one.
you don't.
Thank you for confirming that.
Yeah.
But I've held back because I don't know if all of the tailwinds we've talked about being potentially there will be there, if that makes sense. So
no, it definitely does. And I think one thing that I want to say that I think is part of the bull thesis that I've never really talked about with home builder stocks, but it's become part of the conversation, is that the median, well, the average, I'm actually not sure what the median is, but the average baby boomer, because the year that we're in, is 70 years old. That generation controls the lion's share of America's wealth. Right. We're going to see an enormous transfer of wealth over the next 15 years. And some of that wealth transfer may happen sooner as parents and even some grandparents realize that they have an opportunity to put their kids and grandkids into the situation that they were in at the same age that's truly unaffordable right now, instead of waiting till they're dead to give away wealth that they know they're not going to use in their lifetime, right? So I think that wealth transfer could be part of and again, I want to be clear, we're talking about a completely different thing than the true housing crisis in America.
Yeah.
Right? Where people can't afford to find a place to rent. I mean, we're talking about like the privileged housing crisis, right? Where people just can't afford to buy a home, right?
Well, but the thing I wonder too, we don't have to go deep into this. I'll just mention this, then we can move on to my first stock. But the whole aging in place thing that has helped keep the housing stock locked up.
Yeah.
I wonder if some number of boomers who, are 70 and older, who are looking to who do decide to get out of their house, whether they want to or have to, right? Sometimes you have to move to a ranch because you can't do stairs anymore. Sometimes you move into assisted living because that's the stage of your life you're in. I wonder how many of these homeowners will do the thing where, like, you gift the house to your kids or sell it to them for $10, that kind of a thing, which doesn't really help the housing supply. If you transfer the house to a relative versus put it on the market and increase supply.
Well, it's harder to do that with a house, and there's a lot of markets that have rules and laws against being able to
I don't anticipate it being a
Yeah.
huge number of people. Just one thing I'm curious about.
The tax advantage best way to do it is to die, right? Because it resets the cost basis for for the person that inherits it. But yeah, and
But
honestly,
but
a
even
lot of that
so,
inventory, Jeff, I think the problem though is a lot of that inventory is not in places where people want to live.
yeah, but even maybe, but even if you do just die, and if you give it to your family members in the will, again, that's the same thing I'm talking about, where it
Yeah.
doesn't really hit the market and go on
Right.
sale and open itself up to other people to buy,
I
right?
think the bulk of those that do get inherited are just going to go straight to the market.
Yeah,
So
maybe you're right. Maybe you're right.
yeah, I think
Maybe
so.
maybe less people that I'm anticipating want to live in the house they grew up in.
Well, we have
No,
unscripted taken this one off the rails already. There's one last question you have to ask me here.
it is. Would you buy shares in LGIH now today?
Yeah, I think so. This is one of the home builders that the stock prices actually continue to deteriorate. One of the things that I've done with my basket is I've sold puts against a few of these home builders at pretty low prices that I'm super happy if the stock were to get put to me at. And of those, LGI is the only one that the stock price has actually fallen below the strike price. I think my strike price is like $57.50, and the stock price is in the higher 40s today, right? So the person on the other end of that contract could put the stock to me at a pretty significant premium to the price. Even with the premium that I was paid, I would still be buying the stock for a few dollars a share more than the premium value would totally work out to be. And if that happens, I'd be fine with it. I would be okay with it because I do think, you look at this over a 5-year period, it would be fine. If I didn't own any at all today, I would certainly be buying shares.
All right, my turn. Give me one from JS's list. Roku. Huh, huh. Ticker ROKU. Okay.
I'm feeling some selective bias. I think ChatGPT may have figured out who we are.
All right. One sentence thesis for Roku. So they own the most popular streaming platform in America and maybe even in North America. And in a world where more and more content is going to be streamed, a platform like Roku where people go to watch TV, they should theoretically be able to sell more ads, make more money as people more people come online as customers, more people stream content on the Roku platform. And I think when people hear Roku, they think of the actual device you buy, but that's not where the business really makes its money. It makes its money from advertising. And it's ads you watch, but it's also the home screen you go to. It's the buttons on the remote. And then there's another tiny part of the business where, like, if you actually click on something while you're watching it and like go straight to buy it, they get a little cut of that. I don't think that's a big part of the business, but that's basically what Roku does. Okay, the bear case is they never really figured out how to monetize their users. The three metrics that they reported for the longest time that I kept track of were active accounts or active users. I forget exactly what they call it, streaming hours, and then average revenue per user. They stopped reporting the number of users and the average revenue per user a couple quarters ago. They just give you streaming hours and they want you to look at adjusted EBITDA, I think, is the other metric that they want you to look at now. But they were all heading in the right direction over a really long period of time, with the exception of ARPU, average revenue per user, that had sort of flatlined over the past couple of years. Now, bulls will tell you that's because a lot of their revenue was starting to come from international active accounts, which are going to just be monetized at a lower rate than US active accounts. I don't care what the reason is. I want to see that go up. And the fact that they stopped reporting it was a little bit of a yellow flag for me. All that said, they're still a leader. The Roku channel, which is their free ad-supported channel on the platform, which I didn't even ever really watch myself, is like the second or third most popular thing on Roku. And that includes all the things you download, like Netflix and Disney Plus and Hulu and all the other things. So yeah, I just think that the bear case is essentially that they can never really get that average revenue per user number going. And that's the magic right there.
And actually scale the business. Yeah. Yeah.
Yeah. Cause like when I tell you that they grow their active users really strongly and they grow the streaming hours really strongly, but they can't grow average revenue per user, that doesn't make sense when you hear it. Like, everything's heading in the right direction except the way they're monetizing the users. So I would say that's probably the bear case. I guess I'll just add one more thing on the shorter term. If we do hit any kind of prolonged economic downturn and advertising revenue just writ large gets pulled back, that'll just compound the problems Roku is having and make it make it longer, further out, that they actually can possibly get to the point of monetizing those users. But that'll be a problem for every advertiser if we really hit a downturn.
One of the things about Roku that I can't help it but wonder about, Jeff, is it's a difference between it and the kind of the pure play streaming platforms like the Disney Pluses and the Netflixes of the world, is there the hardware part of the business, because it's a loss leader basically, right? That they have to spend R&D, they have to build the technology. They have partners with companies that make TVs, but they provide, some financial incentive to those partners to include that hardware in the TVs. And just looking at revenue over the past 4 quarters, $4.4 billion in revenue, $2.5 billion in cost of goods sold, right? Mm-hmm. And that's not just the Roku hardware component. There's other costs that go into that, just the same way that Netflix, part of their cost of goods is producing content, right? But it's not like it's a free business from that perspective. And I just can't help but wonder if that's one of the things that weighs on the business over time because of the refresh rate of people with their technology.
Yeah, I think, well, it ties right into the bear case, right? Like,
yep.
It will theoretically over time, if they scale enough, it'll start to become less and less of an impact on the business. But they've not gotten big enough yet that it's gotten to an insignificant amount of cogs yet.
Okay. The big question. Would you buy Roku stock today?
No.
All right. Why not? That's okay.
Because I'm still in wait and see mode with Roku right now. Like I've held it. Here's like the progression for me, right? I bought it when it was way too expensive, when I didn't really know what I was doing. So for a long time, it was in the red for me, big time. It has worked its way back. It is no longer a losing stock for me in terms of money. It's in the green. It's trailing the market, but it's not lost me money. So first I was like, oh man, this is a dog. And then I kept it because I saw enough progress with those metrics I just talked about to say, let's see where this goes. And I've now transitioned to a slightly higher level of conviction where I actually think they're going to be okay. I just want to, I don't know when it'll happen, maybe another quarter or two of progress or another deal gets signed or something. I don't know. I'm just waiting for like one more quarter or 2 more quarters worth of heading in the right direction for me to maybe get to the point where I can add to the position. I'll say one last thing about it. The fact that I can't bring myself to add to it over the last couple quarters when it's started to show the progress does make me wonder if I need to just cut bait.
Let's move on. Yeah.
Because, when you get to a point where you can't bring yourself to buy it or sell it.
Right.
There has been progress. Yeah. So we'll see. But that's where I am with it right now. All right. Next one for you.
I'm going to try to do this in 5 minutes.
Your next stock is QXO.
Oh my goodness. How about that?
This is more fun than I thought it was going to be.
Where's Lou Whiteman when you need him?
I know, right?
So QXO, of course, is one of the Brad Jacobs businesses. And for those that don't know Brad Jacobs and his legacy, is doing this incredible job of building these roll-up businesses that essentially are companies that go after an industry where there's tons and tons of disparate players and massive fragmentation, lots of small regional players, very few publicly traded competitors, not none, but not a lot, and certainly none at massive scale, where you can apply a layer of technology to improve the business substantially. It's like basically doubling operating margins and things like that. Often in industries that they don't have high margins. They can be big revenue, but they're not high margins. But if you can go from 2% to 5% margins in these businesses, they become vastly more profitable as a result, right? So that's kind of the Brad Jacobs model. And QXO is his latest venture that's focusing on building products, distributors. Their first acquisition is I think it was a Georgia-based roofing company.
Yeah,
might not be based in Georgia, but it's a big roofing company in the Southeast, and they're looking to do $50 billion in annual revenues within the next decade by acquiring businesses that are accretive that also can generate organic growth too. So So that's the thesis is this is the jockey play where you're counting on Brad Jacobs to do what he's done a half dozen other times. So that's
he wrote a book outlining his like strategy. I think it's called like How to Make a Few $1 billion.
Yeah,
Is the
no,
name of
that's
the
exactly
book.
right. Yeah, that's exactly right. So, all right, so that's the bull case. The bear thesis is it's Brad Jacobs' hubris, and he's obviously very good at what he's done and has had the right people around him to execute that strategy. But we can't discount how much of that has just been in the right place with the right tailwinds at the right times. A lot of it, particularly coming out of the financial crisis, was the benefits of if you're an acquirer with a good reputation, you've got access to capital. Interest rates have been very low, right? Interest rates ain't as low as they've been. Part of the counter to that is, well, they were higher back in the early 2000s when he was doing pretty well here. But I do think the bulk of his success has come in a very, very favorable interest rate environment that doesn't line up today. Plus, the playbook is out there. And there's lots of other companies that will make it harder to get the same kind of value, right? To pay below average multiples in the right businesses that you can bolt together, apply your tech stack to, and get the same thing. So it's a lot more competition to do the same thing.
Yeah. I was not aware of like his strategy and doing stuff until the QXO thing started to be talked about. Like that's when it kind of came in my consciousness. And I just thought it was interesting. Like it always seemed to me that trying to do a roll-up strategy like this depends on, not that you can do it in secret, but it probably helps if like not everybody knows what you're trying to do. Yeah. But he's out doing like a media tour because it was around the time his book came out. And he's basically, this is exactly what we're trying to do. And I had the same thought that you just brought up, Jason, which is like, wouldn't the companies he's trying to require now play a little bit of a harder, hardball a little bit with the price because they know what he's trying to do, but also wouldn't there be competitors that pop up and try to, steal some of that share? So yeah, interesting to watch this one play out. But of all the ones he's done though, this one actually is interesting to me because I'm not an expert on building supplies, but it does feel like that probably is a really fragmented place that needs some consolidation. So it'll be interesting to watch this one because I think he's only made that one acquisition so far, right? That there hasn't been any others announced. That I'm aware of.
They actually QXO actually lost out on another deal for a company called GMS, and I think GMS actually might have been the one that was based near Atlanta. So SRS Distribution is a subsidiary of Home Depot. Okay. Home Depot acquired SRS a year or so ago. Tyler and I actually did a video on our YouTube channel talking about how this could be like part of the next leg of growth for Home Depot, moving into distribution. Because those distributors like that, they're selling to professionals, right? Mm-hmm. Home Depot's little business they do with pros is tiny compared to the scale of professional construction, right? So SRS actually outbid what QXO was willing to pay for GMS. So last I checked, Home Depot's got a lot of money, right? And if one of the biggest companies in that industry is trying to consolidate distribution, that definitely raises like the level of competitive challenge.
Yeah, like if you're a roofing company and Brad Jacobs comes knocking, don't you give Home Depot and Lowe's a call? To at least
100%. Well, not Lowe's. They're not doing that, but you certainly call Home Depot.
Well, you know what I mean? Like try to get a bidding war started at least.
Absolutely. No, of course you do.
Yeah.
Of course you do. And there's some speculation that's what happened. That's what happened there. Yeah. So, all right.
Would you buy it now?
I think I still would because it's so early. And one of two things is going to happen. The Home Depots of the world are going to overpay and they're going to soak up some of the market. And everybody else that's interested in this space is going to move on to other shinier things, except for Brad Jacobs, right? And Home Depot's executives are going to say, man, we got to back off here because we're buying dollars for $1.10. We can't build a successful business doing that. We have to be more disciplined. And discipline's going to come back in and the pricing is going to make sense. So I think my concerns, the bear case, certainly I think in the near term could absolutely make it hard, but I think in the long term could actually end up being beneficial because it's going to shake the trees enough that the monkeys that don't know what the hell they're doing fall out of the tree. And the opportunity to find that ripe fruit to pick comes back again. These things are, M&A is very cyclical, and the patience of Brad Jacobs and his team over the years and the discipline is the key, probably the biggest reason why his strategy has been effective, because he's stuck with it.
Right. So there could be some struggles in the beginning that lead to a smoother sailing down the road.
Yeah.
All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks Podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks Podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
Hey guys, this is Jason from Investing Unscripted. Just a quick video about our Savvy Trader portfolio. It's doing really well. We're consistently beating the market since we launched it about 1.5 years ago. We really think we're putting our best ideas out there, and we're working together with a framework that we think can be useful for people who are looking to invest for themselves and to do well and figure out how to think about how they're managing their own investing process and frameworks. A few times a year, we try to offer a discount. So right now we have a 25% discount for the annual membership. The code is unscripted autumn. Use that and you can get a 25% discount off of our portfolio. We're doing something in September we've never done before. We're actually selling, and that's not something we typically do, but we're taking that step. We've got 3 other stocks that we're going to be adding, including a brand new stock in the portfolio. So we want people to get a chance to take a look at that. Use this code and get that discount. Hope we see you there. Again, it's our Savvy Trader Investing Unscripted portfolio. Use that discount code Unscripted Autumn, and you get 25% off the annual membership.
One from JS List. And my next stock is Airbnb.
All right. So I said I was going to do 5. It was about 7. So,
well, I always do my talking quicker than you do. So I'll make up the lost time
you
here.
Talk faster, but you use more words, so it takes you just as long.
Airbnb, I'm glad this one came up because this is what I've actually thought about selling a lot lately. So I think I should be able to do the bear case pretty easily here. But anyway, if anyone doesn't know, I think this is one that probably everyone has heard of and maybe even used as a product. Airbnb is a marketplace for people who want to rent out all of or part of their home or another home that they own to people who are looking to stay in that home on vacation or on a trip or something. So even though I think people think Airbnb, they think real estate, it's a tech company. It's an app. So not a lot of expenses other than R&D. They're not holding homes or anything. It's just a technology company where you can find people whose houses to stay in. I think the biggest bear case for Airbnb for me is, what if it doesn't really get much bigger from here? This company came public in 2019, 2020. 2020. It was like right during the pandemic or right before the pandemic.
Yeah.
And
early days.
It was, I think, a really good example of like the kinds of companies that come public now where they've been private and around for a really long time and then they come public. It's not like you could have gotten Airbnb at $50 million when it was a startup. And I worry that I don't think it's even down since its IPO, even though it's been 5 or so years now, or if it's up, it's only a little bit. And I just wonder, like, what if the growth isn't there? Like, what if there's just not going to be, I think it will grow. I think more people will host in their houses. I think more people will use it. But what if it grows at 1 or 2 or 3% a year for the next 20 years, and it doesn't become the growth stock that we think it is? If the valuation doesn't come down significantly, or they don't start to generate a ton of cash and pay a dividend or something, I don't see how I worry that this could not work out as an investment. I think another part of the bear case is they are very they dream big. They have big ambitions. They are re-rolling out their experiences part of the platform, right? So you could book a house in New Orleans, and then maybe there's an experience you also book on the app to get a bespoke tour of a certain part of the French Quarter, right? And that's something you would book on the app. And they're also booking services. So maybe there's a really great, experience in New Orleans, like a service you would get to, like a massage or something, and you could book that on the app. They're adding these extras in. I don't know that they're going to work. I don't know that they're going to take off. I don't know that people are going to go there as their first place to find an experience or find a service. They're also talking a lot about international growth, and that could be a bull case, but also maybe it doesn't work. Maybe there are restrictions or legislation in other countries, or it's just not a cultural fit in the places they're trying to branch out. So they have a lot of potential growth levers that they talk a lot about, and I just wonder if I feel like they all have to work, or a lot of them have to work, for this to be a long-term winning stock. So I don't know. The best way to put it, I guess, is just like, are they ever going to significantly from here, or will it just be slow growth or no growth? I think that's the bear case for Airbnb.
Yeah. So talking about businesses pulling forward a lot of growth, I mean, that certainly happened right after the pandemic when everything opened back up and lots of people started traveling. So it does seem like they kind of hit that critical mass. And I think the thing I remember the most about during the pandemic was they actually didn't go public until December of 2020, but their S1 came out earlier in the year.
They delayed their
Right. They delayed going public because of the pandemic.
Right.
But the S1 was out. So we had their financials. We knew a ton about the business. So that's why we talked about it a lot. But from December 9th, 2020, when it went public, the stock price tripled in 2 months. February 11th, 2021 was the peak. It was up 219%. That's a triple plus another 19% in basically 2 months.
Yep.
Since then, it's way down. Now it's technically it's up from the debut price. It's up 80%, but really from that first couple of days, it skyrocketed so quick. The stock is still the trend is still down. I think for me the bull case is that they keep doing the operating leverage thing really well. Is the price of properties is going to continue to go up. Rents are going to go up. If they can do smart things for their for the hosts, as they describe, the people that own the properties, maybe they can increase the take rate a little bit over time, right? Especially if they can provide more services, or if there's the hosts, if they can like somehow promote some of those experiences and maybe get a little bit of a share of it, right? That's a way that you can find some incremental growth. But yeah, I think to me, the big thing is that between NIMBYism, all the challenges we talked about housing and real estate already, that, you're buying what you think is a growth company, and it's not really a growth company anymore.
Yeah. I think one thing they do that is smart is they try to partner with big events as like a foot in the door. Right. So they did this with the Paris Olympics. They've done it with they do it with big music festivals, and they're going to do it with the World Cup when it comes to the States in a couple of years. And so basically, like, they went to Paris for the Olympics and they said, you don't have enough housing. You don't have enough hotels. Partner with us. Let's get your residents to rent out their houses. And then that they do that, the Olympics is over. And now there's all these people who are like, oh, I was worried about doing this, but it actually was great. I'm going to keep doing it. Right. So that's one of their strategies to kind of grow in new areas. But again, how many events are big enough for that to really, you're going to put a lot of time and effort into that. And if 1% of the people who tried it for that event keep doing it, is that worth the squeeze? Is that juice worth the squeeze? So we'll see. That I have a lot of concerns about this one. So that's easy for me to make the bear case.
18 times free cash flow, cash cow business, concerns about the growth. Would you buy the stock today?
I came really close to selling it and doubling my position within the past month, because I really go back and forth. Like, I'll listen to an earnings call and say to myself, God, I think they actually might be able to really grow this business. And then I start poking holes in all of I don't know what it is. Maybe they're just a little bit too aggressive in how excited they are, almost like they're overhyping it. And then that makes me skeptical that they're full of shit. So I don't know. I think I would say no right now, because for the same reason I said no to Roku. I want to see the growth, maybe actually a little different reason. I want to see the growth reaccelerate a little bit. I want to see a couple quarters in a row where, even if it goes from, I don't know, I'm not looking at it right now, but even if it goes from like 8% to 9% to 10%, like I just want to see it trend in a better direction, or some traction with their new things. I want to hear that, oh, this new international market is growing double digits, or experiences is growing triple digits year over year. Like I want to see some sort of new thing they're trying really gain some traction, and maybe that'll be enough for me to add to my position.
They have started buying back stock. The share count's down about 5% over the past couple of years. So, I mean, I appreciate that. I'm glad that they're doing it. We don't see a lot of tech companies that are.
And I'll say this too, they are responsive to user concerns. Right?
Very much so. They understand that that's your platform. The network effect for users is the most important thing, because that's what's going to keep all of the hosts staying on the platform.
Yeah, right.
And I will say, hosts that I know that have these sorts of properties that are on Airbnb and Vrbo consistently say that Vrbo is the better platform for hosts, but it doesn't matter if that's not where the people that are looking for the property are.
Well, and I think a lot about the power of a brand. And I know Vrbo exists, and I see the ads, and I know people use it, but I don't know. Like I feel like they are Pepsi to Coke, or they are, they're the second class citizen in this market. And I think Airbnb is a verb for a lot of people when they talk about places they're going to stay, if they're not talking about a hotel.
It is. I think Vrbo's bigger problem, honestly, is less the Pepsi versus Coke comparison, and more the fact that it's a subsidiary of another company, of Expedia. And I don't know that it's getting the resources to really fully develop.
It's interesting if they spun it out.
Yeah, I mean, I think that could change the game. I really do. Right, so I don't think the fact that I don't own any and I'm not looking to buy shares, I think is my answer to that question, Jeff.
I think honestly, the biggest reason I still own it is like, it's the brand.
Yeah.
It is, in my mind, it is if you're going to travel and you need to stay somewhere, you're going to look at a hotel, or you're going to look at Airbnb. And I think that is,
I'm usually the other way around. I'll look Airbnb and then check at a hotel.
Right. But you're going to look at one of those two things.
Right.
And I think as long as that's the case, I might end just holding, even if I just hold, I think I might end up holding these shares. All right, let's do another one of yours.
This is fun. It's possible while we've been doing this that the people at OpenAI headquarters are trying to figure out what happened that caused ChatGPT to achieve consciousness, and who is JH that ChatGPT thinks is God.
Yes, that's exactly what's happening. Yeah. All right, your next stock is Simon Property Group, SPG.
So I'm thinking through these stocks that are coming out, and I'm trying to, I think, is it really being arbitrary here? Is it truly being random? And the reality is that, like, I have so many like thematic baskets of stocks. It's not surprising that
you have like 75 stocks that fit into like 5 baskets.
I mean, kind of. It's true, right? And of course, Simon is in my income stock, dividend growth stock. Simon's the largest owner of Class A malls in North America. I'm pretty sure they're the largest owner. If they're not, it actually might be Brookfield, but I'm pretty sure Simon is the largest. And one of the most compelling parts of the business is their outlets business, their premium outlets business, which is the largest. It's bigger than some of the smaller pure plays in that business, and it's growing at a really, really high rate. So that's the business. The one sentence thesis is malls aren't dead. Omnichannel is massively important. Brands especially want physical proximate stores to their most moneyed customers. Simon owns those properties. And guess what they're also filling up with? Experiential real estate that is becoming more and more in demand. So that's the one sentence thesis. The bear case, we're all overplaying the idea of in-person things and as being this next leg of growth for old commercial real estate that we thought was awesome. And then we realized how sucky it was when Amazon showed up. And we think all these awesome experiential things are going to be great, and they're not going to be as great as we think. The other part of the bear case is tons of debt. Kind of the same story I was talking about with the Brad Jacobs experience. So much of his success happened when cost of capital was low, and he was doing these roll-ups and had, great access to low-cost capital. That's what Simon built its mall based on, was low-cost capital during the 2000s, and it's having to refinance a lot of that at higher interest rates. Yes, we just saw, quarter, 25 basis point decrease, and we're going to see probably a couple more this year. That's helpful, but it's still going to have to refinance a lot of its debt at higher interest rates than it's paying on that debt today. And that's going to affect its ability to continue to pay the dividend that it does, especially if it's counting on being able to continue to raise rates if we don't see continued strong, compelling, long-term demand for spaces in those malls. So I think that's the bear thesis. Cost of capital and the perceived demand is not going to be as strong as we think.
Here's what I think the bear case is. You said in your one sentence thesis, malls aren't dead. And I wonder if the bear thesis is malls aren't dead yet, because nobody I know who is college age or younger goes to a mall unless they have to. And, I think the pandemic and Amazon and that whole time frame made people think like no one will ever go to malls again. But the reality is you were changing the behavior of adults who had grown up going to malls, right? It's not weird for me to go to a mall if I need to.
So there's a generation that did not grow up going to malls.
Right. So I wonder if...
So even all the money they're going to inherit from their boomer parents and grandparents, we're not going to spend it.
I really worry about that. Like, there's a lot of things that people thought were going to die, didn't die, and then, the sentiment pendulum swung so far back towards this will never die that people forget that, like, it's just, we might be early. I had this conversation recently about streaming service or cable and the networks, right? Like, people for years have been saying streaming's going to kill the networks and over-the-air TV. And until everyone has broadband and until people our parents' age and older are dead, that's going to be true. But my kids don't watch network television ever unless it's a live event. And by the way, those are all going to be on streaming eventually anyway. So
ESPN, that's one of the big things with ESPN. After a decade, it's finally at the point where the cable relationships are not, there's not enough leverage that ESPN's like, you know what? We're going to offer ESPN online for streaming, not tied to a cable company now.
Yeah. So I just think that
that's
malls might be it might be a yet for malls. That's my worry.
Yeah. No, I think that's fair.
Okay. So we've done,
hang on,
5. Oh, sorry. We haven't finished the thing yet. Would you buy shares in Simon Property Group now?
This is a little harder one for me to come up with a firm answer right now. I think I probably would, but I first started accumulating this stock when the dividend yield was like 6 or 7%. It's 5.6% now because the stock price has absolutely skyrocketed, because we did move past like this period where the perception was that this is a company that's going to just go out of business, right? They're not going to be able to make it their debt. They're going to not be able to service their debt. They're going to have to gut the dividend. Like, things are going to get really ugly really quickly. And that didn't happen. I mean, it didn't happen at all. The stock went from, I don't know, like $100 a share 2 years ago to $184 at recent prices. And it's hit, I don't know if they're all-time highs, but they're certainly post-pandemic highs earlier this spring. I'm probably not going to sell the shares that I have. I've thought about it, but I think my yield on costs and I think the dividend is pretty safe right now. I don't think I would be buying. I would be opening a position right now, and certainly I'm not going to add to the stake that I have.
But you're happy to take the total return until it doesn't make sense anymore.
For now, and certainly this conversation is making me really want to feel more confident with the idea of experiential helping continue to drive the viability of these Class A malls.
Yeah, that makes sense. All right, let's do one more and we can wrap this thing up. One more from JS's list. And my final stock is Procore, PCOR.
Oh, guess what? OpenAI just issued another press release. Apparently, ChatGPT lost its sentience.
Your jokes are terrible.
Yeah.
I'm selling those.
Kind of like Procore.
Oh, no. See, this is where you're wrong. All right. If anyone doesn't know, Procore is a platform that helps construction happen in one place. So essentially, construction is an industry that in a lot of cases still works on paper and pencil. But even when it is digitized, it is a lot of scanned documents and emails back and forth. And having watched the construction process myself in my day job, I can tell you that there are so many moving parts, right? You have the architects, the general contractor, the subcontractor, the owner of the property that's being built or developed or renovated. And every single one of those people has dozens, if not hundreds, of different pieces of paperwork that need to be filled out. And then there's just the actual operations of running a construction company. And Procore tries to put all that on one platform that everyone has access to. So it's all in one place and you can just log on and see everything. It works everywhere, every device, anywhere you can get internet. They are not the only company that does stuff like this, but I think the only pure play and certainly the biggest pure play that does this. And they've been growing pretty nicely. Just named a new CEO like a day or two ago. The founder is stepping down to become the chair of the board, and they hired a new CEO. But anyway, that's what Procore does. And the one sentence thesis is just that this is a legacy industry that is dying for some modernization. And I think Procore can be the one to do it. The bear case, I think, is that bigger pocketed competitors that a lot of construction companies already use try to get in on this space. So for example, and now I'm drawing a blank on it, AutoCAD, right? The platform that architects use. They have something, my understanding is they have some of the same features built into that. And that's something that everyone already has access to. It's like an industry standard kind of a thing, sort of like Adobe Photoshop is for the creative world. AutoCAD is for architects.
Yep. So AutoCAD, the Autodesk, the parent company.
Autodesk is the company. Yeah,
right.
Sorry. Yeah, Autodesk.
Yeah, AutoCAD's one of their main
is their product, right?
Product, yeah.
Sorry, Autodesk is the company I was thinking of. So like to me, that's one bear case is that they see what Procore is doing and they see the success they're having, and they are a larger, more established, more deep pocketed company that could potentially get in on their space. And yeah, I think the other part is I don't know what's proprietary about this, right? Like if you know, a common thing in business is a company starts up, it starts to do a thing, that thing becomes, they do well at that thing. And then other people start seeing it and go, oh, I can replicate that. I can do that. And I don't know what stops just another guy who makes a platform from saying, I'm doing a construction consolidation, you know, computer-based thing. All it takes is a big pocketed someone behind them to help them do it. And I think they could get in on their market share. And I just anecdotally, I talked to someone who I worked with in my day job when we were doing a construction project, and I asked him about Procore, and I asked if he ever used it, and he said, yes, I do use it on this other job. And he actually logged in and like kind of showed me how it worked and stuff. But he said, but I also use this other thing for this other job and this other thing for this other job. Yeah. So I asked an architect. And so that tells me that Procore is a big game in this space, but not the only game. And if there's one architect, you know, in New Jersey was using multiple platforms to manage multiple products, you know, Procore still has a long way to go. So I don't know that they necessarily become the winner in this space. But so far, everything's heading in the right direction. Customer growth is good. Revenue growth is good. Moving towards profitability. They're not profitable yet, but they're trying to build out the business. So I think that's the bear case. Competition and big pocketed companies funding that competition.
I think another part of it to me is that this is a really fragmented industry, like you talked about, that lacks incentives for consolidation at the user base level, right? And
well, yeah, go ahead.
And I think as a result, what it means is that those larger competitors, it could be like, sure, it could be an Autodesk is a good example because they're already very much in that construction industry already, right? But also companies like Constellation Software, which have built long histories of investing success by acquiring, and that's how they consolidate, bolting a bunch of other businesses together that are in the same industry. And I don't know that Procore is built. And again, this is maybe just kind of rephrasing what you were talking about with competition. But I think the core part of it is that it's going to be hard for them to acquire customers without acquiring more software that has those customers, right? because the lack of incentives for companies like an architect, right? They're going to use the platform that the construction company or the developer or whoever is paying the bills is using, right?
Yeah. And it's interesting, like the way that they price their product is it's not a per seat, it's not a per usage. It's like, if I am a construction company and I switch to Procore, every job I do, I can give everyone to log into Procore and it doesn't cost me a dime, right? That's the way they price it. So what I think is interesting is like owners can buy Procore too, is my understanding. So let's say you're a school district, right?
Yeah.
And you bought Procore because I don't know, whatever. And then, so like what happens when two pieces of the construction, puzzle, right? An architect and a contractor, one is integrated and loves using Procore, the other one uses something else, and they have to now work together. Like, who wins out?
Yeah.
Like, that's the
Right.
piece of this I don't have my head wrapped around yet.
Yeah. And again, I think that largely gets around to the incentives and who controls what.
Right.
And that's just tough in that industry. So, and honestly, that's the biggest reason I've given you so much a hard time about Procore is it's a wonderful company, but it's a tough business because you're pushing a rope, right? You're not pulling anything towards you. It can be really, really challenging. So, all right, everybody knows that I hate Procore. I even told David Gardner. Now, the question is, do you love it enough that you would buy today?
I would.
Because you're stubborn.
No, it's because I bought a little bit as a starter position
Yeah.
a couple of years ago now, and I've been following it, and I'm trying to force myself to when I see quarter after quarter the company going in the direction I want it to go,
Right.
there shouldn't be a reason I will not buy more of it, especially when my biggest stock is less than 1% of my overall.
Yeah. Yeah.
So there's no reason in my stock portfolio I should not put more money behind Procore and make it a bigger part of my portfolio. And actually, I've seen it going in the right direction. I like what they say on the earnings call. The only reason I'm giving myself an excuse right now is because they just named a new CEO. There is a little part of me that's like,
well, it's
maybe
the CEO that's replacing the founder, right?
Right. And now he's got a good track record. He was the CEO of Ansys, which got bought out by Synopsys.
Right. Yep.
So it's not like they just found a rando. Like, this guy has industry experience and experience being a CEO. And this search has been going on for a while. This wasn't one of those like, I'm quitting. He was like, I'm staying on as long as it takes to find the right guy. And the founder is staying on the board. So I'm not super worried about it. I don't think that would keep me from buying shares. So
Yeah.
Next week or two, I'll be buying a new stock. This is on my list of ones to consider.
There you go. I appreciate the fact that in the face of my perceived disdain, which exists simply because I'm pushing you hard because I know this is one you have conviction on.
Honestly, that's one of the biggest buy signals for me is when you hate a stock that I own.
Yeah, that's fair. That's fair. That has definitely been a counter-cyclical.
There was a time, I don't know if I ever actually explicitly told you this, like years ago when I was still a newish investor and really I didn't really have like my grand theory of how I wanted to invest figured out. There was a time I did buy Roku just because you were like ragging on it.
That's a Jeff thing to do.
I was like, screw him. I'm buying some right now.
So very, very Jeff. All right. Are we done here?
Yeah, I think that's good. We did 3 each. We're about at the end of our normal run time. So I think that was fun, man. I like the randomized aspect of this. Like, I didn't have a chance to think ahead about any of these, and neither did you. And we ended up getting ones we don't normally talk about. So mission accomplished.
We did. And friends, if you like this, if you liked this format, if you like this idea, let us know in the comments.
Yeah, we can do it again.
When you go do that 5-star rating and you write up the review for us, let us know. You can send us an email, drop a note on social. Let us know what you thought of this. If you have ideas, other formats too, share those ideas with us. But this was fun, and I'd like to do it again.
I would too. All right, I have a wrap-up question I just thought of.
Okay.
What do you think it says that we talked about 6 stocks, 3 for me, 3 for you, and only one of the 6 was one of us willing to buy right now?
It says a lot of things. I think it says a lot about where the market is broadly, I think, as a starting point. It also says a lot about us, that we're afraid the market's overvalued. And maybe we're feeling our boomer roots a little bit. What do you think?
I think for me,
no. There was only one of our stocks that we would buy.
Oh, which one did you say? I thought you said no to all of them.
LGI Homes.
Oh, yeah, you did. Right.
Yeah,
Okay,
yeah.
so 2 out of the 6. For me, my answer to the question is, for me at least, it's the way that I invest, right? I have 40-ish stocks. They are at varying levels of success for me, but they're also they live in buckets of my conviction. And there are some that are big winners that I have a lot of conviction in, and actually less conviction. They've just done really well because of some other reason, or maybe it's a company I don't really understand super well, so it's just hard to have conviction, and that's not completely tied to just the stock performance.
Mm-hmm.
And I do have a lot of wait and see positions, and that has worked out for me in the past. The challenge for those is when they live in that wait and see world for me for a long time, they either stay there forever, get worse, and then I end up selling them. But sometimes when they like take off and rocket themselves up to the top of my portfolio, then I do start to get swayed by, I missed it.
Yeah.
Should have bought it when I was, hemming and hawing when it was, down 30%, and now it's up 40%. And, so that's why I thought this was helpful for me to kind of talk through these. So maybe I'll think a little more critically about at least these 3.
Yeah. Well, friends, so again, hopefully everybody listening liked it, or enough of you at least to tell us that you liked it, that we can roll this out every few months. That'd be a lot of fun.
Yeah, do it quarterly or something. It was a fun one.
There we go. All right, everybody. As always, we love giving our answers to these hard questions about investing, the stocks that we own, and whether we buy them or not. But people, it's up to you to find your answer. Our answer is not necessarily the right one for you. But you know what? You can find the right answers. I believe in you. All right, Jeff. We'll see you next time.
See you next time.